Have you ever wondered how to master cryptocurrency trading? Well, you're not alone. It's a digital frontier where fortunes can be made and, yes, lost. But what is cryptocurrency trading really? It's the act of buying, selling, and exchanging digital currencies like Bitcoin, Ethereum, and many others. It's a bit like the stock market, but with digital coins instead of company shares. The potential benefits are enormous. Imagine being part of a financial revolution, having the opportunity to generate substantial profits and gaining the freedom to trade 24/7. But let's not forget the risks. Market volatility can swing both ways, and there's always the chance of losing your investment. But don't worry, we're here to break down the process into simple, easy-to-understand steps. We'll guide you through the nitty-gritty of cryptocurrency trading, from understanding the basics to executing your first trade. So, if you're intrigued by the world of digital currencies and want to navigate it with confidence, you're in the right place. Before diving into trading, it's crucial to understand what cryptocurrencies are. Cryptocurrencies are digital or virtual currencies that use cryptography for security. Unlike traditional currencies issued by central banks, cryptocurrencies are decentralized, operating on technology called blockchain, a distributed ledger enforced by a network of computers, also known as nodes. Now you might be wondering, why is decentralization important? Well, it means that cryptocurrencies are immune to government interference or manipulation. They're truly global, not bound by exchange rates, interest rates, or other charges of any specific country. The first and most well-known cryptocurrency is Bitcoin, created in 2009 by the mysterious entity known as Satoshi Nakamoto. Bitcoin introduced the concept of cryptocurrencies to the world and remains the most valuable and influential one. Its scarcity and decentralization have led some to call it digital gold. But Bitcoin is far from the only game in town. There's Ethereum, for instance, the second largest cryptocurrency by market capitalization. Ethereum is more than just a currency. It's a platform that enables developers to build and deploy their own decentralized applications, or dApps. Its native cryptocurrency, Ether, acts as a fuel for these dApps. Cryptocurrencies have caused quite a stir in the world of finance. They've been hailed as the money of the future, a tool for financial freedom, and a speculative asset for traders. Their significance in today's digital age is undeniable, and they're changing the way we think about money, value, and trust. It's important to note that while cryptocurrencies offer a lot of potential, they're also highly volatile and can be risky investments. They're subject to wild price swings, regulatory scrutiny, and technological challenges, but for those willing to navigate these risks, they offer a world of opportunities. With a basic understanding of cryptocurrencies, we can now explore how to trade them. To start trading, you first need a place to store your cryptocurrencies, a digital wallet. Imagine, if you will, a digital wallet is akin to your online banking account. It's a place where you can store, send, and receive cryptocurrencies. But here's the difference. Unlike traditional banks, if you lose access to your digital wallet, there's no customer service to call to retrieve it. This fact alone underscores the importance of having a secure digital wallet. Now, how do you set up a cryptocurrency wallet? It's actually quite simple. The first step is to decide between a hardware wallet or a software wallet. A hardware wallet is a physical device, somewhat like a USB stick, that stores your cryptocurrencies offline. This makes it less vulnerable to hacking attempts. On the other hand, a software wallet is an app that you install on your phone or computer. It's more convenient, but also more susceptible to online threats. Once you've made your choice, the next step is to choose your wallet provider. There are many providers out there, each with their own set of features and security measures. When choosing, consider the reputation of the provider, the security features it offers, and the types of cryptocurrencies it supports. After choosing a wallet provider, you'll need to download the wallet software or purchase the hardware. Then, you'll need to set up your wallet. This usually involves creating a password and backing up your wallet. Remember, this backup is crucial. It's the only way to regain access to your wallet if you forget your password or lose your device. Lastly, take a moment to familiarize yourself with the wallet's interface. Know how to send and receive cryptocurrencies. Understand how to check your balance and transaction history. And there you have it. You've set up your digital wallet. But remember, as with all things in the crypto world, security should be your top priority. Never share your password or backup phrase with anyone. Now that you've set up your wallet, you're ready to enter the cryptocurrency market. The next step is selecting a cryptocurrency exchange, which is where the trading happens. Now, you might be thinking, what exactly is a cryptocurrency exchange? Well, it's essentially a digital marketplace where you can buy, sell, or trade cryptocurrencies. Think of it as a stock market, but for digital currencies. Choosing the right exchange can be a little daunting, but don't worry, we'll break it down for you. The first thing to consider when choosing an exchange is security. As you're dealing with digital assets, it's crucial to pick an exchange that takes security seriously. Look for features like two-factor authentication, encryption, and cold storage for funds. Secondly, consider the user interface. Especially if you're a beginner, you need an exchange that's simple to navigate. You don't want to be lost in a jungle of charts, graphs, and technical terms. Some exchanges even offer a demo mode for you to practice trading without risking real money. Next up, transaction fees. Each exchange has its own fee structure. Some charge a flat fee, while others might take a percentage of your transaction. It's important to understand these fees up front to avoid any unpleasant surprises. Also, consider the exchange's reputation. Read reviews, ask around in online forums, and do your own research. Remember, your hard-earned money is at stake. Lastly, consider the types of cryptocurrencies the exchange supports. If you're interested in trading Bitcoin, Ethereum, or Litecoin, most exchanges will support these. But if you're looking to trade more exotic or less common cryptocurrencies, you'll need to find an exchange that supports them. Now keep in mind, there's no one-size-fits-all exchange. What works best for you depends on your personal needs and trading goals. So take your time, do your research, and don't rush into anything. With your chosen exchange, you're one step closer to making your first trade. Now, it's time for the exciting part, making your first trade. Imagine standing in a bustling market, traders shouting out prices, buyers haggling, and amidst the chaos, you're there, ready to make your first purchase. That's what trading cryptocurrencies on an exchange feels like. But don't worry, it's not as daunting as it sounds. First, let's understand what an order is. An order is simply your instruction to buy or sell a cryptocurrency at a particular price. There are 3 types of orders that you need to know about: market orders, limit orders, and stop orders. Market orders are the simplest. You're telling the exchange, I want to buy or sell this cryptocurrency at the best available price right now. The exchange then matches your order with the best available one from other traders. Limit orders, on the other hand, are a bit more strategic. In this case, you're saying, I want to buy or sell this cryptocurrency, but only when the price reaches a certain level. You set your desired price, and the order will only be executed when the market price matches it. Finally, we have stop orders. Think of them as your safety net. You're telling the exchange, I want to buy or sell this cryptocurrency, but only if the price goes beyond a certain level. It's a way to limit your losses or secure your profits when the market moves in an unexpected direction. Now, armed with this knowledge, you're ready to make your first trade. Choose your cryptocurrency, select the type of order, set your price if needed, and click the buy or sell button. And just like that, you've made your first trade. But let's not get ahead of ourselves. Successful trading requires more than just buying and selling. It's about understanding the market trends, managing your risks, and staying patient. It's about making informed decisions and not letting emotions cloud your judgment. Congratulations on making your first trade. But remember, successful trading requires more than just buying and selling. Successful traders don't just rely on luck, they analyze the market. Market analysis is the compass in the vast ocean of cryptocurrency trading. It's the process of evaluating and interpreting data about the market, which includes price charts and market trends. It's like reading the roadmap to your trading destination. Without it, you're navigating blindly. Now let's talk about chart reading. This is one of the most fundamental skills in market analysis. When you look at a price chart, you're looking at a graphical representation of price movements over a certain period. Each bar or candlestick on the chart represents a specific time frame, and the color indicates whether prices went up or down during that time. By studying these charts, you can identify patterns and trends that can help predict future price movements. Understanding market trends is another crucial aspect of market analysis. A trend is the general direction in which the market is moving. There are 3 types of trends: uptrends, downtrends, and sideways trends. In an uptrend, prices are generally rising. In a downtrend, prices are generally falling. And in a sideways trend, prices are fluctuating within a certain range without a clear upward or downward direction. But how can you identify these trends? by looking for higher highs and higher lows for uptrends and lower highs and lower lows for downtrends. Sideways trends, on the other hand, are characterized by roughly equal highs and lows. Also, keep in mind that trends can be short-term, medium-term, or long-term. It's essential to consider the time frame of your trading strategy when identifying trends. So there you have it, the basics of market analysis in cryptocurrency trading. Remember, the more you understand about the market, the better you can navigate it. It's all about making informed decisions based on solid data and logical reasoning. With these analysis tools, you'll be better equipped to make informed trading decisions. In cryptocurrency trading, managing your risk is just as important as seeking profit. The volatile nature of cryptocurrencies makes them a high-risk, high-reward venture. Therefore, developing a solid risk management strategy is crucial. There are several strategies you can employ to manage risk effectively. One key strategy is setting stop losses. A stop loss is a predetermined level at which you'll sell your cryptocurrency to avoid further losses. It's like an insurance policy against the market turning against you. If the value of a cryptocurrency you hold starts to fall, a stop loss can limit your losses by automatically selling at a certain point. This helps keep your losses within a range you're comfortable with and can prevent a small loss from becoming a catastrophic one. Another important risk management strategy is diversifying your portfolio. Just like traditional investing, it's not wise to put all your eggs in one basket. By spreading your investments across various cryptocurrencies, you can mitigate the risk of one currency's downfall severely impacting your portfolio. Moreover, a golden rule of investing that applies to cryptocurrency trading is never invest more than you can afford to lose. This might seem obvious, but in the heat of a bull market, it can be easy to get carried away. Remember, the value of cryptocurrencies can fluctuate wildly, and there's always a chance you could lose your entire investment. Lastly, it's important to keep a cool head and not let emotions dictate your trading decisions. Fear and greed can lead to rash decisions, like buying at a peak or selling at a loss. It's crucial to stick to your strategy and make decisions based on careful analysis, not emotions. These strategies are not foolproof, and there's no guarantee of success in cryptocurrency trading. But by incorporating these risk management techniques, you're more likely to navigate the tumultuous seas of cryptocurrency trading safely. By managing your risk effectively, you can protect your investment and potentially increase your profits. Let's recap what we've covered today. We embarked on this journey by introducing cryptocurrency trading, exploring its dynamic nature and the potential for profit that draws so many to its digital shores. We delved into the core understanding of cryptocurrencies, unraveling their intricacy and highlighting their decentralized nature. We underscored the importance of transparency, security, and the role of blockchain technology, which serves as the backbone of these digital assets. Taking the next step, we guided you through setting up a cryptocurrency wallet. This is your personal gateway to the crypto world, a digital safe where your coins and tokens are stored. We emphasized the importance of security, urging you to protect your private keys and to consider using hardware wallets for extra safety. Next, we navigated the complex landscape of cryptocurrency exchanges. We detailed how to choose the right platform based on factors like security, liquidity, and transaction fees. We stressed the importance of carrying out due diligence, ensuring that the chosen platform aligns with your trading goals and risk tolerance. From there, we dove into making your first trade. We outlined the process of buying and selling cryptocurrencies, detailing the differences between market orders, limit orders, and stop orders. We explained how to read a candlestick chart, emphasizing the importance of understanding market trends and price movements. Our journey then led us to market analysis, a crucial tool in your trading toolkit. We explored technical and fundamental analysis, showing how they can help predict future price movements and inform your trading decisions. We highlighted the significance of staying abreast of market news and understanding the volatility of the crypto market. Finally, we discussed the all-important topic of risk management in cryptocurrency trading. We explained how to set stop-loss and take-profit levels, stressing the importance of a well-planned strategy and disciplined approach to trading. We advised against investing more than you can afford to lose and highlighted the importance of always conducting thorough research. Remember, mastering cryptocurrency trading takes time and practice, so stay patient, stay informed, and happy trading.